All right, you know that feeling, right? The calendar flips over and suddenly that little whisper starts. Tax season.
Oh, yeah. The stack of mail starts piling up.
Exactly. Or just that vague dread, about all the forms and what you don't know.
Well, hopefully today we can help end that feeling.
That's the plan. We're here to turn that overwhelm into some real understanding.
Definitely. Think of this deep dive as your personal guide through the 2024 tax filing season. We're not just listing rules here.
No, no.
We want to simplify this often, let's face it, complex world of tax forms, decode what it all means for your money.
And most importantly, find ways to save.
Exactly. Uncover those opportunities. It's really about empowering you, helping you make smart financial moves, not just like ticking boxes.
That is the mission. So forget the giant mountain of paperwork.
Right.
Today we are turning it into a molehill of mastery. We're going deep. Understanding your Form 1040.
Figuring out what income you actually need to report.
Spotting those deductions, claiming credits.
Managing payments.
Yep.
All of it.
Yep. All with a sharp focus on practical tips. Things that can save you money. And maybe a few headaches, too.
Let's do it.
Okay, let's kick things off by setting the stage for 2024. The tax world, it shifts a little every year, doesn't it?
It does. Always some tweaks.
So knowing what's new, and maybe even more basic who actually needs to file, that's step one for a smoother season, right?
Yeah, absolutely. That's the perfect place to start.
So what are some of the biggest updates we should be aware of for this year?
Well, probably one of the most impactful changes for a lot of taxpayers is the increase in the standard deduction for 2024.
Ah, okay. Heard about that.
Yeah, and it's not just a tiny adjustment. It's a pretty significant boost, actually. It can directly affect how much tax you end up owing.
So what are the new numbers?
Okay, so for single filers, or those married filing separately, the standard deduction is now $13,850.
13,850. Got it.
If you're married filing jointly, or a qualifying surviving spouse, that jumps to $27,700.
Wow, 27.
And for headed household filers, it's $20,800.
20,800.
Right. And the big insight here really is that these higher amounts mean even more people will likely find it simpler and maybe more beneficial to just take the standard deduction.
Instead of itemizing all their deductions.
Exactly. Reduces taxable income without needing, tons of extra paperwork.
That makes sense. Those are pretty big jumps. And aren't there also extra amounts for some situations, like for older folks or if someone's blind?
That's right. Good point. If you're 65 or older, or if you're blind, you get to add an extra $1,500 to your standard deduction amount.
1,500 more.
Yeah. And if you happen to be single or filing as head of household and you meet one of those criteria, 65 plus or blind, that additional amount is even higher. It's $8,850.
Okay, $8,850 then.
It's sort of a targeted benefit aimed at providing a bit more relief where it might be needed most.
And speaking of making things simpler, I know the IRS has been really pushing some new free filing options lately. That sounds like a great way for listeners to save on tax prep fees, maybe.
It really is a positive step. They're making something called Direct File, a permanent option starting in 2025 for individual federal returns.
Direct file, okay.
The idea is for it to be a free, direct, and secure way to file online right with the IRS.
Interesting. What about for this year, for the 2024 taxes we're filing now?
Right. For 2024 taxes, you still have the IRS Free File program that offers free tax prep software from various partner companies, but you usually need to meet certain adjusted gross income requirements.
Ah, okay. Income limits.
Yeah. But there's also free fillable forms. Those are available for pretty much anyone, regardless of income. They're basically electronic versions of the paper forms.
So more for people comfortable doing taxes themselves.
Exactly. More for experienced filers. But the main point is you might not need to pay for tax preparation, especially if your return isn't super complicated. Definitely worth checking out.
That's a solid tip. Okay, beyond those broad changes, were there any specific, maybe more nuanced updates for certain situations, things people might easily miss?
Yeah, there are always a few specific ones. For instance, if you take an early distribution from a retirement plan, before retirement age, there's usually an additional tax.
Right, the penalty.
That penalty calculation now has exceptions, or rather, the definition of what distributions avoid the extra tax now includes payments made for certain emergency personal expenses. up to a certain limit, of course.
Oh, interesting. Like unforeseen emergencies.
Kind of, yeah.
Hmm.
And also for victims of domestic violence making withdrawals, it acknowledges specific hardships, gives a bit more access, though the distribution itself is still generally taxed as income.
Okay, that makes sense. Any other specific things?
On a more positive note for some folks, the IRS clarified that qualified wildfire relief payments, and also certain relief payments related to the East Palestine train derailment, those are not taxable.
Oh, good. So if you receive those, just don't report them as income.
Exactly. Don't include them. That's a big relief, I imagine, for those affected.
Definitely. Any other, like, reporting changes, how things show up on forms?
Yes. Non-taxable Medicaid waiver payments.
Mhm.
These are sometimes received by people caring for individuals at home. They now have a more dedicated spot. Generally reported in Box 12 of the W-2 form using Code 2. Just helps standardize things.
Okay, Box 12, Code 2.
Also, starting in 2024, there's a new rule for surviving spouses who are beneficiaries of a retirement plan or IRA. They can now elect to be treated essentially as the original employee for the required minimum distribution, or RMD rules.
What does that mean practically?
It offers some potentially valuable flexibility in how and when they take distributions from inherited accounts. It's a bit complex, depends on ages and specifics, but it's a new option.
Good to know. Flexibility is usually welcome.
And one last one, really specific but crucial for a certain group. 2024 is the final year to file Form 5405. This relates to the 15-year repayment period for the first-time homebuyer credit, but only for homes bought way back in 2008.
Wow, 2008. That's reaching back.
It is. But if that applies to you, this is literally the last chance to deal with that repayment on your tax return.
Okay, good heads up for anyone in that boat. So that covers some key updates. But let's back up a step. Before we even get into the forms, who actually has to file a return? It seems simple, but it's not always just about hitting an income number, is it?
It's definitely not always intuitive. The general rule is pretty broad. Filing requirements apply to all U.S. citizens, doesn't matter where you live,
Even abroad.
and also to resident aliens. It's a wide net, basically ensuring global tax compliance for the U.S.
Okay. Citizens and resident aliens.
Then you get into the specific gross income thresholds that generally trigger the need to file for 2024. These amounts are tied to your filing status and age.
Right, like the standard deduction amounts we just mentioned.
Exactly. So for instance, if you're single and under 65, you generally need to file if your gross income was $13,850 or more.
Okay.
If you're married filing jointly, both under 65, that threshold jumps to $27,700.
So if your income is below that, you might not have to file.
You might not, unless other rules apply. But yes, those thresholds essentially cover your standard deduction.
And gross income, that's not just your paycheck, right?
Yeah.
What does that actually include? People might miss things.
That's an excellent point. Gross income is much broader than just salary. It includes basically all income you received in any form, money, goods, property, services, unless the law specifically says it's exempt from tax.
So bartering counts, selling stuff online.
Potentially, yes. It can include income from sources outside the U.S., maybe gains from selling your home. Even if part of that gain isn't taxed, the IRS defines it very comprehensively.
So the key takeaway is think broadly. Think about all the ways money or value came to you during the year.
Precisely. Don't just think about your W-2.
Okay. Are there situations where you might need to file even if your gross income is below those main thresholds, like special cases?
Absolutely. This is where it gets a little more detailed. You might need to file, for example, if you're married, filing separately and had gross income of at least $5. That's $5.
Wow, just $5.
Yeah, particularly if you didn't live with your spouse at the end of the year. It's a very low threshold in that specific case.
Okay. What else?
You also need to file if you owe certain special taxes, like the alternative minimum tax, or AMT.
Ah, the AMT. Heard of that. Kind of a parallel tax system.
Sort of, yeah. Designed to ensure higher income folks pay at least some minimum tax, even with lots of deductions. Or another case, if you got advance payments of the premium tax credit for health insurance through the marketplace.
From healthcare.gov or a state exchange.
Right. You have to file to reconcile the amount you received with the amount you actually qualify for. You might need to repay some if you got too much up front.
Okay, that makes sense. Health insurance credits.
Also, if you're claiming certain non-refundable tax credits, things other than the basic child tax credit or the credit for other dependents, think like education credits or the foreign tax credit, you usually have to file to claim those.
Even if your income is low.
Even if your income is below the normal filing threshold. And of course, if you owe other specific taxes like self-employment tax or household employment taxes, like if you paid a nanny,
The nanny.
right, then you definitely need to file, regardless of your total gross income hitting those standard levels.
This all really hinges on your Social Security number, your SSN, doesn't it? What about people who don't have one? What's an ITN?
Your SSN is definitely the primary identifier for the tax system. But if you don't have an SSN and you're not eligible to get one, maybe because of your immigration status, but you still have a U.S. tax filing requirement, then you need an individual taxpayer identification number, or ITN.
Okay, an ITN.
It's specifically for tax purposes. Important thing to know. Getting an ITN can take time,
Yeah.
like maybe 7 weeks or so. So you need to plan ahead if you need one.
7 weeks. Good to know. And what about keeping them current? Do they expire?
They can, yes. This is crucial. Some ITNs expire if they haven't been used on a federal tax return for the last 3 tax years. So for returns covering 2021, 2022, or 2023,
So if you haven't filed recently with your ITN.
you need to check if it's expired.
Yeah.
If it has, and you need to file for 2024, you must renew it first. Filing with an expired ITN will cause delays.
Okay, check your ITN status if you haven't used it lately. What if someone starts with an ITN and then later gets a Social Security number? How do they switch over?
Good question. If you get an SSN after using an ITN, you absolutely must stop using the ITN immediately.
Stop using the ITN.
And then it's really important to notify the IRS. You need to let them know so they can combine your tax records under your new SSN. This prevents confusion and ensures your entire tax history is linked correctly.
Makes sense. Okay, so you figured out you need to file. Next big step, choosing your filing status. This feels like more than just checking a box, right? It impacts quite a bit.
It absolutely does. Your filing status is fundamental. It determines your standard deduction amount, your eligibility for various credits and deductions, and even the tax rates that apply to your income. Big impact.
What are the forms people use now? Is it still mostly the 1040?
Yes, Form 1040 is the main one for almost everyone. However, there's also Form 1040 SR.
That's
Yeah,
right.
it's an option specifically for taxpayers who were born before January 2nd, 1960, so generally age 65 or older.
What's different about the 1040 SR?
Functionally, it's the same tax calculation, but it's designed to be a bit easier to read, larger print, a clear chart for the standard deduction right on the front page. Just a bit more user-friendly for older taxpayers, but it's optional.
Nice option to have. Okay, let's talk about some of the trickier statuses. Married filing separately. When might someone choose that, and what are the rules?
Right. Married filing separately, or MFS. You can choose this if you're married at the end of 2024, but decide to file your own return, separate from your spouse.
Okay. Why would someone do that? Seems like filing jointly is usually better.
It often results in less tax overall if you file jointly, that's true. But people might choose MFS for specific reasons. Maybe one spouse doesn't want to be legally responsible for the other spouse's tax liability, perhaps due to past issues or complex finances.
Separating the liability.
Exactly. Or sometimes, if a couple lived apart for the last 6 months of the year and meet other specific tests, MFS might be required or advantageous depending on state law too. Also, if one spouse is a non-resident alien and they don't elect to be treated as a resident for tax purposes.
Okay. And what do you need to do on the form if you file MFS?
You have to enter your spouse's name and their Social Security number, or ITN, on your return. If your spouse is a non-resident alien and isn't required to have an SSN, you'd enter NRA instead.
NRA for non-resident alien. Got it. But generally, MFS means higher tax and fewer credits.
Generally, yes. You often lose out on certain credits, the standard deduction is lower than joint, and the tax brackets can be less favorable. It's usually worth running the numbers both ways if you're considering it.
Good advice. Okay, what about head of household? That one seems to have very specific, sometimes confusing rules. Can you break those down?
Yes, head of household is often beneficial, better tax rates, and a higher standard deduction than single. But the rules are strict. You basically need to meet 2 main conditions. You must be unmarried, or considered unmarried for tax purposes, on the last day of the year.
Considered unmarried. How does that work?
That usually applies if you're married but lived apart from your spouse for the last 6 months of the year, filed a separate return, and paid more than half the cost of keeping up your home, which was also the main home of your dependent child, for more than half the year.
Okay, so specific living apart rules.
Right. And the second main condition is that you must have paid more than half the cost of keeping up a home for the year.
Keeping up a home, like rent, mortgage, utilities.
Exactly. Rent, mortgage interest, property taxes, utilities repairs, food eaten in the home. things like that.
And who has to live in that home?
This is where the tests come in. There's Test 1 and Test 2. Test 1 is interesting. It applies if you paid over half the cost of keeping up a home that was the main home for the entire year for your parent, whom you can claim as a dependent.
My parent.
Yes, and the really interesting part, your parent doesn't actually have to live with you for this test.
Wait, really? So if I, say, pay more than half the cost of my mom's apartment or nursing home, and I claim her as a dependent?
Then, even if she doesn't live in your house, you could potentially qualify for head of household under Test 1. It's a specific scenario, but valuable if it fits.
Wow, okay. That's a good nuance. What's test 2?
Test 2 is more common. It applies if you paid over half the cost of keeping up your home, and a qualifying person lived with you in that home for more than half of the year.
A qualifying person, that's usually a dependent child or relative.
Usually, yes. There are detailed rules defining who counts as a qualifying person. Relationship, age, residency tests often apply. But generally, it's a dependent child or sometimes another close relative who meets specific criteria. The key is paying over half the costs and having that qualifying person live with you for over 6 months.
Got it. Strict rules, but potentially very beneficial. What about non-resident or dual status aliens? Filing jointly sounds complicated there.
It can be quite intricate, yeah. The general rule is that a married couple can't file a joint return if either spouse was a non-resident alien at any time during the tax year.
So separate returns, usually?
Usually. However, there's an important election. If one spouse was a non-resident alien at the end of the year, but the other spouse was a U.S. citizen or resident, they can choose to treat the non-resident spouse as a U.S. resident for the entire year.
Then file jointly.
And file jointly, yes. This election means all their worldwide income becomes subject to U.S. tax, which is a big consideration. And once made, this choice generally stays in effect for future years unless formally terminated.
So a big decision with long-term effects.
Absolutely. There's also an option for dual status aliens, people who are both non-resident and resident aliens in the same year. They can sometimes elect to be treated as a resident for the whole year too, but that's usually a one-year election. These require careful thought and often professional advice.
Definitely sounds like it. Okay, one last thing before we dive into income details. Digital assets. Crypto, NFTs. This is still pretty new territory for taxes, isn't it?
Yeah.
What's the main thing people need to know for 2024?
It's definitely an area the IRS is focusing on. The most prominent thing for 2024 is the question right near the top of Form 1040 and 1040-SR about digital assets.
Yeah, I remember seeing that last year. It's still there.
Yes. And you must check either yes or no. You have to check yes if at any time during 2024 you did certain things with digital assets.
Okay, what kind of things trigger a yes?
It's if you receive digital assets, think Bitcoin, Ethereum, NFTs, stablecoins, as a reward, award, or payment for property or services. Or if you sold, exchanged, gifted, or otherwise disposed of a digital asset or any financial interest in one.
So buying and holding doesn't require a yes.
Just buying and holding generally doesn't, no.
Yeah.
But receiving them as payment or reward or disposing of them in almost any way, that triggers the yes box. The key insight is the IRS wants to know about these transactions. They're tracking them.
Okay, so check yes if you did any of that. Then what? Where does the actual income or gain get reported? It seems like there are different ways you could get digital assets.
Exactly. Where you report, it depends on how you received or disposed of it. If you got digital assets as ordinary income, maybe from mining, staking rewards, or receiving crypto as payment for services, and it wasn't reported elsewhere like on a W-2.
Right, like freelance work paid in crypto.
That ordinary income generally goes on Schedule 1 in the other income section. There's a specific line now for digital asset income not reported elsewhere.
Schedule 1, other income.
Yeah.
Okay. What about selling crypto, like capital gains?
If you sold, exchanged, or spent digital assets that you held as a capital asset, like an investment, then you report the capital gain or loss. That usually involves Form 8949 to detail the transactions.
Cost basis, sale price.
Exactly. And then you summarize those gains or losses on Schedule D, just like selling stocks.
Form 8949 and Schedule D for capital gains. What about gifting crypto?
Gifting digital assets generally doesn't create income for the giver or receiver right away. However, if the value of the gift is above the annual exclusion amount, which is pretty high, but possible with volatile assets, the giver might need to file Form 709, the gift tax return.
Okay, so gifting has its own rules. But the main thing is, check the box if required, and then report the income or gain in the right place. Schedule 1 for ordinary income, Schedule D for capital gains.
That's the gist of it. proper classification and reporting are key to staying compliant.
All right. With that foundation laid, the updates, who files, filing status, digital assets, let's dive into the real core of the return, decoding your income. This is where everything starts, right? What you report, where you report it. It all flows from here.
It absolutely does. This section lays the groundwork for calculating your tax. And sometimes understanding what doesn't need to be reported is just as important for saving money.
Good point. So let's go through the main income categories people see on their Form 1040. First up, probably the most common, wages, salaries, and tips.
Right, usually the first income line. Your main source document here is your Form W-2, the wage and tax statement from your employer.
Box 1 is wages. Box 2 is federal tax withheld. Seems straightforward.
Mostly, yes. Box 1 generally shows your taxable wages, salary, and other compensation. Box 2 shows how much federal income tax was already taken out. But there are a few nuances even here.
Like what? What about tips? Especially cash tips someone might get that weren't reported to the employer.
Great question. That's a common one. If you received cash or non-cash tips and didn't report them to your employer, you still have to include them in your income on your tax return.
Non-cash tips too, like if a customer gives you tickets to something.
Yep. You have to determine the fair market value of those tickets and report it as income. Also, look at Box 8 on your W-2. That's for allocated tips.
Allocated tips.
Sometimes, for large food and beverage establishments, if reported tips are below a certain percentage of sales, the employer might have to allocate additional tip income to employees on the W-2. You have to report this allocated amount as income unless you have records to prove your actual unreported tips were lower.
Ah, so keep good records of your actual tips.
Absolutely crucial if you get tips. And remember, unreported tip income might also mean you owe Social Security and Medicare taxes on it, which you calculate separately, often on Form 413D7.
Okay, tips need careful handling. What about those Medicaid waiver payments we mentioned earlier? How do they fit into income?
Right. If you receive taxable Medicaid waiver payments that weren't included in Box 1 of your W-2, you'd report them here. But here's the interesting strategy part we touched on. Even if the payments are considered non-taxable difficulty of care payments.
Non-taxable, so you don't pay income tax on them.
Correct. However, you have the option to include these non-taxable amounts in your earned income calculation when figuring certain tax credits, like the earned income credit or the child tax credit.
Wait, so you can choose to count non-taxable income to potentially get a bigger credit?
Exactly. It might increase your adjusted gross income slightly, but if it pushes you over a threshold to qualify for or maximize a credit, you could be beneficial overall. It's a specific election you can make.
That's fascinating. Definitely something to look into if that applies to you. What other kinds of earned income might show up in this general wages area besides a standard paycheck?
Several things can fall here. Scholarship or fellowship grants that weren't reported on a W-2 often go here, but only the taxable portion.
Taxable portion.
Yeah, amounts used for tuition and required fees are usually tax-free, but amounts used for room and board, for example, are generally taxable.
Yeah, okay. What else?
Excess elective deferrals. If you contributed too much to your retirement plans across all jobs in 2024,
More than the limit, like over $23,000 if under 50.
right, for 2024, $23,000 was the general limit, plus catch-up if 50 or older. If your total deferrals exceeded your limit, that excess amount is considered taxable wages in that year.
Ouch. So you got to track contributions if you have multiple jobs.
Definitely. Also, disability pensions received before you reach your employer's minimum retirement age are usually reported as wages.
Before minimum retirement age.
Yes. Once you hit that minimum retirement age, the payments are typically reported as pensions on a different line. It's about timing.
Interesting distinction.
And corrective distributions from retirement plans, like if you took out excess contributions plus earnings, those often get reported here too. But not regular IRA distributions. Those have their own lines.
Okay. And what about that combat pay election for military members?
Right. If you received non-taxable combat pay, you have the option to include it in your earned income, specifically for calculating the Earned Income Credit, EIC. This doesn't make the combat pay taxable income overall, but counting it for the EIC calculation might increase the amount of that refundable credit you get.
Another strategic choice then.
Exactly. And one last thing in this area.
Statutory employees.
Statutory employees. That sounds specific. It is. If Box 13 on your W-2 has the statutory employee box checked, it means although you're treated as an employee for some purposes, like withholding, you report your wages and related expenses on Schedule C, like a self-employed individual.
So they file a Schedule C for business profit or loss.
Yes. The big advantage is they can deduct their work-related expenses directly against that income on Schedule C, which regular employees generally can't do anymore after recent tax law changes.
Ah, okay. So that little checkbox in box 13 makes a big difference.
Huge difference for those individuals.
All right, let's shift gears from earned income to investment income. Dividends are pretty common. How do those work on the tax return? Are all dividends treated the same?
No, not all dividends are equal in the eyes of the IRS. There are generally two main types reported on your 1040: qualified dividends and ordinary dividends.
Qualified dividends, those are the better kind, tax-wise, right?
Usually, yes. Qualified dividends are eligible for lower tax rates, the same favorable long-term capital gains rates, which are often 0%, 15%, or 20%, depending on your overall taxable income.
Much better than regular income tax rates.
Much better. This can lead to significant tax savings, especially for long-term investors. You'll typically find the amount of your qualified dividends in Box 1B of your Form 1099 DIV.
Box 1B on the 1099 DIV, but are they always qualified if they're in that box?
Not necessarily. There are holding period requirements and other rules. Most dividends from major U.S. corporations and many foreign corporations will qualify if you meet the holding period, but it's not automatic. The 1099 DIV usually gets it right, but there can be exceptions.
Okay, so qualified dividends get lower rates. What about ordinary dividends?
Ordinary dividends are all dividends that aren't qualified. These are taxed at your regular income tax rates. The total amount of your ordinary dividends is usually shown in Box 1A of your Form 1099 DIV.
Box 1A, and where do these go on the 1040?
There are separate lines for qualified dividends and total ordinary dividends. If your total ordinary dividends are more than $1,500, or if you receive dividends as a nominee, meaning they belong to someone else, you also have to fill out and attach Schedule B, interest, and ordinary dividends.
Schedule B if over $1,500. Got it. What about things called non-dividend distributions? Sometimes those show up on a 1099 DIV, too.
Right, non-dividend distributions, often shown in Box 3, are different. They're generally considered a return of your original investment, your cost basis.
Return of costs, so not taxed.
Not immediately. They reduce your cost basis in the stock or fund. They only become taxable once your basis reaches zero. Any amount you receive after your basis is zero is then treated as a capital gain, which you'd report on Form 8949 and Schedule D.
Okay, so track your basis if you get non-dividend distributions. Important distinction.
Very important to avoid paying tax too soon.
All right, let's talk about retirement accounts. IRA distributions, taking money out of your individual retirement arrangement. How does that impact your taxes?
IRA distributions are another major income category. Generally, you report the total amount of the distribution on one line, line 4A on the 2024 Form 1040, and the taxable amount on the next line, line 4B.
Total versus taxable amount. Why the difference?
Well, if you made only deductible contributions to your traditional IRA over the years, then your distributions are usually fully taxable. But if you made non-deductible contributions, then part of your distribution represents a tax-free return of those contributions. You typically use Form 8606 to figure out the taxable portion.
Form 8606 for non-deductible contributions. Okay. Are there ways to take money out of an IRA without it being taxable? We hear about things like QCDs.
Yes. This is where some really valuable tax strategies come in, especially for older individuals. Let's talk about qualified charitable distributions, or QCDs.
UCDs, what are those exactly?
If you are age 70 and a half or older, you can direct up to $105,000. For 2024, this amount is indexed for inflation per year from your traditional IRA directly to eligible charities.
Directly from the IRA to the charity.
Yes, the money can't touch your hands, and if done correctly, that amount is not included in your gross income.
Wow, tax-free withdrawal for charity.
Exactly. And what's fascinating here is this can also satisfy your required minimum distribution, RMD, if you're subject to those, generally starting at age 73 now.
So you meet your RMD without adding to your taxable income.
Precisely. This can be huge. It might help keep you in a lower tax bracket, potentially reduce the amount of your Social Security benefits that are taxed, and maybe even help you avoid higher Medicare premiums that are based on income. It's a powerful tool.
That sounds like a fantastic strategy for charitably inclined retirees. Are there any catches?
The main one is you can't also claim a charitable deduction for the same amount you excluded from income via the QCD. No double dipping. And it has to go directly to a qualified public charity, not donor-advised funds or private foundations.
Okay, direct to charity, no deduction, but satisfies RMD tax-free. Great tip. Are there other tax-free IRA withdrawal options?
There's another interesting one, though much more limited, the HSA funding distribution, or HFD.
Funding your health savings account from your IRA.
Yes, You can make a one-time only lifetime transfer from your traditional or Roth IRA directly to your health savings account, HSA.
One time ever.
One time ever per person. The amount transferred is not included in your income, and it's not subject to the usual 10% early withdrawal penalty if you're under 59 and a half.
Tax-free transfer to an HSA, what are the limits or rules?
The amount you transfer counts towards your maximum HSA contribution limit for that year, so it reduces how much else you can contribute to the HSA. And there's a critical testing period. You must remain eligible for an HSA for the 12 full months following the month of the transfer.
What happens if you don't stay HSA eligible for 12 months?
Then the amount you transferred becomes taxable income, and you also get hit with that 10% additional tax. So you need to be pretty sure you'll maintain HSA eligibility for the next year if you use this strategy.
Okay, powerful, but use with caution. Good to know these options exist. What if you get multiple IRA distributions in a year?
You just figure the taxable amount for each type of distribution, regular, QCD, HFD, and then report the totals on the appropriate lines.
All right. Similar topic. Pensions and annuities. How are those taxed? Are they treated like IRA distributions?
Similar, but with their own nuances. These are reported on lines 5A, total amount, and 5B, taxable amount, of the 1040. Like IRAs, whether they're fully or partially taxable depends on whether you contributed to the cost of the plan with after-tax money.
So if the employer paid for it all or you used pre-tax money, it's fully taxable when you get it back.
Generally, yes. If you contributed after-tax dollars, then part of each payment is a tax-free return of your cost basis. You usually use the simplified method worksheet in the IRS instructions to figure out the taxable portion each year for pensions and annuities.
Simplified method. Okay. Now here's where it gets really interesting for a specific group. That exclusion for retired public safety officers. Can you explain that again? It sounds like a unique benefit.
It is a very specific and valuable tax break. If you are an eligible retired public safety officer, think police, firefighters, EMTs, you can exclude from your income up to $3,000 of distributions from your eligible retirement plan, like a pension or 401k, if that money was used to pay for qualified health insurance premiums.
Premiums for health insurance or long-term care insurance.
Yes, for yourself, your spouse, or dependents. The key is the money must be paid directly from the retirement plan to the insurance provider, or you need to have paid the premiums yourself and elect the exclusion.
So up to $3,000 of otherwise taxable pension income becomes tax-free if used for insurance.
Exactly. It directly reduces the taxable amount you report on line 5B. You report the total pension on 5A, the reduced taxable amount on 5B, and you should write PSO next to the line to indicate you're claiming this public safety officer exclusion.
PSO, great tip for retired first responders. What about lump sum distributions from pensions?
Those can be complex. Sometimes special tax treatments might apply, like 10-year averaging for certain individuals born before 1936. Also, an early distribution not rolled over might be subject to that additional 10% tax.
Okay. Moving on to Social Security benefits. Big question everyone asks, are they always taxable? Or only sometimes?
And not always taxable. That's a common misconception. Whether your Social Security benefits are taxed depends on your provisional income.
Provisional income, what's that?
It's basically your adjusted gross income, AGI, not counting Social Security benefits, plus any tax-exempt interest income, like for municipal bonds, plus 1/2 of your Social Security benefits for the year.
Okay, AGI plus tax-exempt interest plus half of Social Security.
Right. You compare that provisional income to certain base amounts. For 2024, if your provisional income is more than $25,000 for single filers or $32,000 for married filing jointly, then some of your benefits start becoming taxable.
25K single, 32K joint. And how much becomes taxable?
It's tiered. If your provisional income is between the first base amount, 25K, 32K, and a second higher base amount, 34K single, 44K joint, then up to 50% of your benefits may be taxed. If your provisional income exceeds that second base amount, then up to 85% of your benefits could be taxable.
Up to 85%. Wow.
Yeah. The key insight is that your other income sources heavily influence whether and how much of your Social Security is taxed. There's also a special rule. If you're married filing separately and live with your spouse at any time during 2024, then 85% of your benefits are generally taxable, regardless of income.
Ah, another downside to MFS if you live together.
Exactly.
What if someone gets a big lump sum Social Security payment that includes benefits for earlier years? Can that push them into a higher tax bracket unfairly?
It absolutely can. And that's where the lump sum election method comes in. This is a critical tool. If your 2024 benefits include a lump sum that was actually for one or more prior years, you have a choice. You can either include the entire lump sum in your 2024 income calculation, or you can use this special election. The election lets you figure the tax on the lump sum portion as if you had received it in the actual earlier years it was due.
So it prevents that artificial income spike in the current year?
Precisely.
Hmm.
You compare the tax calculated both ways, including it all now versus using the election, and you pay the lower amount of tax. It often results in significant savings by keeping you out of higher tax brackets or preventing more of your other benefits from becoming taxable in the current year. There's a box to check on the form if you use this election.
Definitely worth looking into if you get a retroactive payment. Okay, last big income category on the main form. Capital gains and losses, selling stocks, bonds, property.
Right. Generally, these transactions are reported on Schedule D, capital gains and losses, and supported by Form 8949, sales and other dispositions of capital assets. Schedule D calculates your net short-term and long-term capital gain or loss.
Short-term versus long-term matters for tax rates.
Break time. Short-term gains, assets held 1 year or less, are taxed at your ordinary income rates. Long-term gains, assets held more than 1 year, get those preferential lower rates, just like qualified dividends.
Okay, so Schedule D in Form 8949 usually. Is there a simpler way sometimes?
Yes, there's an exception. If your only capital gains for the year are capital gain distributions reported in Box 2A of your forms, 1099 DIV.
Just those mutual fund distributions.
Right. And you don't have any other capital gains or losses to report, and you don't need Schedule D for other reasons, you might be able to report those capital gain distributions directly on the main Form 1040 line 7 in 2024, without filing Schedule D.
Simplifies things for basic investors.
It does. But if you sold any stocks yourself or have losses or other complexities, you'll likely need Schedule D.
Got it. Now, before we leave income, we should touch on Schedule 1 again. It's not just for digital assets. It has a whole Part I for additional income. What are some key things there people might overlook?
Schedule 1, Part I, catches various income items not listed on the main 1040. One common one is taxable refunds, credits, or offsets of state and local income taxes.
State tax refunds, are those always taxable?
No, and this trips people up. A state or local income tax refund is only taxable if you itemize deductions on your federal return in the year you paid that tax, and you actually got a tax benefit from deducting it.
So if I took the standard deduction last year, this year's state refund is usually tax-free.
Usually, yes, because you didn't get a federal tax benefit from deducting the state taxes in the first place. If you itemized, you might have to include some or all of it as income. It depends on a tax benefit rule calculation.
Okay, crucial distinction there. What about alimony? That changed recently.
It did. For alimony received, it's only included in the recipient's income if the divorce or separation agreement was executed on or before December 31st, 2018.
Before 2019.
Right. It hasn't been modified after that date to explicitly state the alimony isn't includable in income. For agreements executed after 2018, alimony is generally not taxable to the recipient and not deductible by the payer. A major shift.
Big change. What else is on Schedule 1, Part 1?
Things like business income or loss, from Schedule C, farm income or loss, Schedule F, unemployment compensation, which is taxable, gambling income, also cancellation of debt.
Canceled debt can be income.
Sometimes, yes.
Oh.
If a lender forgives debt you owe, that forgiven amount might be considered taxable income. However, there are many exceptions like insolvency or bankruptcy, or for certain student loan discharges. It's complex, often needs Publication 4681.
Okay. Any others we should highlight?
Foreign earned income exclusion for people working abroad reported via Form 2555. We mentioned digital asset income not reported elsewhere. Also, potentially taxable disaster relief payments or taxable distributions from Coverdell Education Savings Accounts or qualified tuition programs, 529 plans, if not used for qualified expenses. It's really a catch-all for income that doesn't fit on the main form.
So check Schedule 1 carefully for anything that applies to you.
Definitely. Meticulous income reporting is step 1.
Fantastic breakdown of income. Now for the exciting part, right? Unlocking tax savings. This is where deductions and credits come in. How can listeners use these to reduce their tax bill?
This is where the strategy really comes into play. Let's start with deductions. Remember, deductions reduce the amount of your income that is actually subject to tax. They lower your taxable income.
Less income tax means less tax paid.
Exactly. And the first big decision, as we mentioned, is standard deduction versus itemizing.
With the standard deduction being higher now for 2024?
Right. $13,850 single, $27,700 joint, $20,800 head of household. Plus those extra amounts for age 65, plus or blindness. For many, the standard deduction will be the easier and better choice. You only itemize if your total itemized deductions, like medical expenses above a certain threshold, state and local taxes up to $10K, home mortgage interest, charitable gifts, add up to more than your standard deduction amount.
Okay, so add up potential itemized deductions compared to the standard, take the bigger one.
That's the basic idea. But even if you take the standard deduction, don't stop there. There are still crucial deductions available called adjustments to income.
Adjustments to income. These are sometimes called above-the-line deductions.
Exactly. They're listed in Part 2 of Schedule 1, and they're powerful because you can take them even if you don't itemize. They directly reduce your adjusted gross income, or AGI.
And lowering AGI is good for other reasons too, right? Like qualifying for credit.
Absolutely. Lowering your AGI can be key. So let's look at some important above-the-line deductions. First one, educator expenses.
For teachers and other educators.
Yes. If you're an eligible educator, K-12 teacher, instructor, counselor, principal, or aide working at least 900 hours during the school year, you can deduct up to $300 of unreimbursed expenses.
$300 per educator, so $600 if married, filing jointly, and both are educators.
Correct. Up to $300 each. And it's not just for books or supplies. It covers professional development courses, computer equipment, or software used in the classroom. And interestingly, for 2024, it still includes costs for COVID-19 protective items like masks and sanitizer bought for classroom use.
Still includes PPE.
Okay.
What's the key thing for this deduction?
The expenses must be ordinary and necessary. Things you paid for out of pocket that weren't reimbursed. It's a direct way to get a tax break for money many educators spend anyway.
Great benefit. What's another key adjustment?
The health savings account, HSA deduction. This is a big one. If you made contributions to your HSA during 2024.
Contributions you made yourself, not from your employer.
Right, your own contributions, unless there are rollovers or that special HFD from an IRA. You can deduct those contributions up to the annual limit.
And HSAs are great because...
Triple tax advantage.
Yeah.
The money goes in tax deductible, it grows tax-free, and withdrawals are tax-free if used for qualified medical expenses. It's an incredibly powerful savings tool, both for healthcare and potentially retirement.
So deducting HSA contributions is a no-brainer if you contributed.
Definitely. Maximize that deduction if you can.
What about moving expenses? That used to be common, but I heard it changed.
Drastically changed. The moving expenses deduction is now extremely limited. It's basically only for members of the armed forces on active duty who are moving because of a permanent change of station due to military orders.
So no deduction for regular job-related moves anymore for civilians?
Nope. That deduction was suspended for most taxpayers by the 2017 tax law changes.
Yeah.
So very narrow application now.
Okay. Good to clarify. What about self-employed people? They pay extra taxes, right?
They pay self-employment tax, which covers their Social Security and Medicare contributions. But there's a related deduction, the deductible part of self-employment tax.
How does that work?
You get to deduct 1/2 of what you paid in self-employment tax for the year. This deduction helps offset the burden of paying both the employer and employee halves of these taxes. It's a crucial adjustment that lowers AGI for anyone with self-employment income.
Deduct half your SE tax. Important. Now, here's where it gets really interesting, especially for freelancers or small business owners. The self-employed health insurance deduction. That's a huge expense.
It absolutely is, and this deduction is a lifesaver for many. The self-employed health insurance deduction lets you deduct the premiums you paid for medical, dental, and qualified long-term care insurance.
For yourself.
For yourself, your spouse, and your dependents. And here's what's fascinating. It also includes premiums paid for your child who was under age 27 at the end of 2024, even if they weren't your tax dependent.
Wow, under 27, even if not a dependent. That's broader than usual.
It is. It's a specific carve-out for this deduction.
So who qualifies to take this deduction?
You generally need to have a net profit from self-employment, like from a Schedule C or F or partnership income. Or if you're a partner or a shareholder who owns more than 2% of an S corporation, you might qualify based on wages received from the S corp.
Okay, so you need business income or S corp wages. Are there any major catches?
Yes, a big one. You cannot take this deduction for any month during which you're eligible to participate in any subsidized health plan maintained by an employer.
Your employer or your spouse's employer?
Either one. If you could have gotten subsidized coverage through an employer plan for a given month, you can't deduct your self-paid premiums for that month. This prevents double benefits.
Okay, eligibility for employer coverage knocks it out month by month.
Right. But if you weren't eligible, this deduction is fantastic. It essentially lets you pay for health insurance with pre-tax dollars, similar to how employees benefit from employer plans.
Huge tax saver. Okay, another big deduction people ask about. The IRA deduction for contributions to a traditional IRA.
Yes. This allows you to potentially deduct the contributions you make to your traditional IRA, up to the contribution limit for the year, $7,000 under 50, $8,000 for 50 plus in 2024.
Potentially deduct. Why potentially?
Because your ability to deduct traditional IRA contributions depends on a couple of things. First, you, or your spouse, if filing jointly, need to have earned income.
Earn income like wages, self-employment income.
Right. And for IRA purposes, non-taxable combat pay and taxable alimony received under the old rules also count. But the bigger factor for many is whether you are covered by a retirement plan at work.
Ah, like a 401k or a pension plan.
Exactly. If you are covered by a retirement plan at work, your ability to deduct your traditional IRA contributions is phased out based on your modified adjusted gross income, MAGI.
So if your income is too high and you have a work plan, you might not get the deduction.
Correct. There are specific income phase-out ranges published by the IRS each year. If your MAGI falls within or above that range, your deduction is reduced or eliminated entirely.
But you can still contribute to the traditional IRA, right? Even if it's not deductible.
Yes, you can still make the contribution up to the limit, even if it's not deductible. Those are called non-deductible contributions. The money still grows tax-deferred, which is a valuable benefit itself. You just need to track those non-deductible amounts using Form 8606 so you don't pay tax on them again when you take distributions later.
Okay, so deduction depends on work plan coverage and income, but contributing is still often worthwhile for tax-deferred growth.
That's a great summary.
The last adjustment we'll highlight, student loan interest deduction.
Right. If you paid interest on qualified student loans during the year, you can deduct the amount you paid up to a maximum of $2,500 per return per year.
$2,500 max.
Yeah. This deduction also has income phase-out, so higher earners might get a reduced deduction or none at all. But for many people actively paying student loans, it provides some welcome tax relief.
Definitely helpful. Okay, that covers the key above-the-line adjustments that reduce AGI. Now let's shift to tax credits. These are even better than deductions, aren't they?
They really are. Deductions reduce your taxable income, but credits reduce your actual tax liability, dollar for dollar. Think of it like a coupon applied directly to your final tax bill. Much more powerful.
Dollar for dollar reduction. Love that. Let's talk about the big ones for families. The child tax credit and the credit for other dependents.
These are major credits. The child tax credit, CTC, can be worth up to $2,000 per qualifying child, with a portion potentially refundable, meaning you can get it back even if you don't owe tax, through the additional child tax credit, ACTC.
Qualifying child. What are the key requirements there?
Several tests. Relationship, age under 17 at the end of the year for the full $2,000 CTC, residency, lived with you for more than half the year, support, child didn't provide over half their own support, and crucially for the $2,000 credit, the child must have a Social Security number that's valid for employment.
SSN, valid for employment. What if the child has an ITIN instead?
If the child has an ITIN or an SSN not valid for employment, they don't qualify for the $2,000 CTCTC. However, they might still qualify you for the smaller, non-refundable credit for other dependents, which is worth up to $500.
$500 credit for other dependents. That applies to older kids too or other relatives.
Yes, qualifying children who are too old for the CTC, like age 17 or 18, or older if a student, or other qualifying relatives you support, like an elderly parent, can potentially get you this $500 credit.
Okay. What about divorced or separated parents? Who claims the child for these credits?
That depends on custody agreements or IRS tiebreaker rules. Often, the custodial parent claims the child. However, the custodial parent can release the claim to the non-custodial parent using Form 8332. If there's a pre-1985 divorce decree or agreement, different rules might apply allowing the non-custodial parent to claim them. But even if the non-custodial parent claims the child for the credits, it generally doesn't allow them to claim head of household status or the earned income credit based on that child.
Complex rules for separated families. Now, a crucial caution here. The IRS is strict about claiming these credits correctly, right?
Extremely strict. This is paramount. There are severe penalties if you claim these credits when you're not eligible. If the IRS determines your error was due to reckless or intentional disregard of the rules, you can be banned from claiming the CTC, ACTC, and the credit for other dependents for 2 years.
2-year ban for recklessness.
And if they find you claimed them fraudulently, the ban is 10 years. Plus, you could face other accuracy-related penalties and interest.
10 years. Wow.
Yeah, the message is clear. Be absolutely sure you meet all the requirements before claiming these credits. Don't guess. It's just not worth the risk.
Solid warning. Okay, another major refundable credit, the Earned Income Credit, or EIC. This one can be huge for lower to moderate income workers.
This raises an important question for many listeners.
Mm-hmm.
Could you be eligible for the EIC? It's a significant credit designed to supplement wages for working individuals and families. And because it's refundable, it can result in a substantial refund even if you owe very little tax.
Who generally qualifies?
It depends on your income and the number of qualifying children you have. The income limits go up with more children. For 2024, for example, a single person with 3 or more qualifying children needed investment income below a certain threshold and earned income AGI below $59,899. If married filing jointly, that AGI limit was $66,819. There are different limits for 2 children, 1 child, and even for workers with no qualifying children, though the income limit and credit amount are much lower then.
So check the income limits for your family size. What about SSN requirements?
Yes, you, your spouse, if filing jointly, and any qualifying children you claim for the EIC must all have valid Social Security numbers issued before the tax return due date. ITN won't work for the EIC, and the SSN card can't say not valid for employment unless it was issued that way solely because you needed it for federal benefits.
Valid SSNs required for everyone. Any cautions about EIC refunds? I think there's often a delay.
Yes, that's important for planning. By law, the IRS cannot issue refunds for any return claiming the EIC or the Additional Child Tax Credit, ACTC, before mid-February. This applies to the entire refund, not just the EICTC portion.
Entire refund held until mid-February.
Correct. It's an anti-fraud measure, gives the IRS extra time to verify eligibility. So if you file early expecting a quick refund and you're claiming EIC or ACTC, just be prepared for that built-in delay.
Good heads up. Okay, what about credits related to saving for retirement? Anything to encourage that?
Yes. There's the Retirement Savings Contributions Credit, often called the Savers Credit. This is specifically designed to help low to moderate income taxpayers save for retirement.
How does it work?
You can get a credit for a percentage of the contributions you make to eligible retirement plans. This includes traditional Roth IRAs, 401ks, 403bs, governmental 457b plans, simple IRAs, SEPs, and even contributions to ABLE accounts for individuals with disabilities.
So it covers a wide range of savings accounts.
It does. The amount of the credit depends on your adjusted gross income and your filing status. The lower your income, the higher their credit percentage, up to 50% of the first $2,000 contributed, or $4,000 if married, filing jointly. It phases out completely at higher income levels.
So a direct incentive to save if your income is within the limits.
Exactly. It makes your retirement contributions effectively cheaper by giving you some of it back as a credit. Great way to boost your savings.
Definitely worth checking eligibility for. What about education costs? College is expensive. Are there tax credits?
Yes, there are 2 main education credits.
Yeah.
The American Opportunity Tax Credit, AOTC, and the Lifetime Learning Credit, LLC.
AOTC and LLC, what's the difference?
The AOTC is generally more generous, up to $2,500 per eligible student per year, but it's only available for the first 4 years of undergraduate education. A portion of it, $1,000, is also refundable. The LLC is less generous, up to $2,000 per return per year, but it can be used for undergraduate, graduate, and even courses taken to acquire or improve job skills, and there's no limit on the number of years you can claim it. It's not refundable, though.
So AOTC for undergrad, potentially refundable.
Yeah.
LLC for broader use, non-refundable. Can you claim both?
No, you have to choose one or the other per student per year.
Yeah.
Usually claim the AOTC if you qualify because it's generally better.
No. What was that fascinating strategy you mentioned earlier about potentially increasing these credits? Something about grants.
Ah, yes. This is a nuance. Normally, scholarships or grants used for qualified tuition and fees are tax-free. However, a student can elect to include some or all of a tax-free scholarship or grant, like a Pell Grant, in their taxable income if doing so allows them, or their parents claiming them as a dependent, to qualify for a larger AOTC or LLC.
So pay a little tax on the grant to get a bigger credit.
Potentially. By including the grant in income, it means your out-of-pocket qualified expenses might increase, which could boost the credit amount. You have to run the numbers carefully, but sometimes it results in a net tax savings overall.
Interesting trade-off. And the same warnings about fraudulent claims apply here too.
Yes, absolutely. Just like the child-related credits, claiming education credits improperly due to recklessness can lead to a 2-year ban, and fraud can lead to a 10-year ban, plus other penalties. Accuracy is crucial.
Okay. Any other non-refundable credits people might encounter on Schedule 3, just to give a flavor of what else is out there?
Sure. Schedule 3, Part I lists various non-refundable credits. Some examples include the foreign tax credit to avoid double taxation on income tax by another country, credits for clean energy like the New Clean Vehicles credit or the Residential Clean Energy credit, the mortgage interest credit, a specific program, not the regular deduction, and the credit for the elderly or the disabled.
Lots of different possibilities.
Definitely. The key takeaway is don't just stop at the big common credits. Review Schedule 3 and the instructions carefully to see if any of these less common, specific credits apply to your situation. Every eligible credit claimed reduces your tax bill directly.
Great advice. Okay, we've covered income, deductions, credits. Let's get practical now. Payments, refunds, and what happens if you owe. How does the IRS track payments made during the year?
Good question. The main way is through withholding. Federal income tax withheld is shown on line 25 of the 1040. This amount comes primarily from Box 2 of your W-2 forms.
From your paychecks.
Right. But it also includes withholding from other sources, like pensions or IRA distributions, Form 1099-R, Box 4, or sometimes from unemployment benefits, dividends, or other payments reported on various 1099 forms. You need to add up all the federal withholding from all your forms.
And attach copies of those forms showing withholding.
Yes. Generally, you need to attach copies of any W-2s and any 1099s that show federal income tax withheld.
What about estimated tax payments? For self-employed people or those with investment income?
Those are reported separately. On line 26 for 2024 estimated tax payments. This includes any quarterly payments you made directly to the IRS throughout 2024 using Form 1040-ES.
Okay. Does it also include last year's refund if you applied it?
Yes. If you had an overpayment on your 2023 return and chose to apply some or all of it to your 2024 estimated tax, you include that amount here as well.
Got it. What if a couple paid joint estimated taxes during the year but decides to file separate returns now? How do they split those payments?
They can divide the joint estimated tax payments between their separate returns in any way they both agree on.
As long as they agree. What if they can't agree?
If they can't agree, they generally have to divide the payments in proportion to each spouse's individual tax liability shown on their separate returns. So, communication and agreement beforehand is definitely easier.
Good tip. Okay, so you filed, done all the calculations, and good news, you're getting a refund. What's the best way to get that money?
Hands down, the easiest, safest, and fastest way is direct deposit. The IRS heavily promotes it. Something like 8 out of 10 taxpayers use it.
How does it work?
You just provide your bank account information, the routing number, and your account number directly on your tax return. Lines 35B, C, and D on the 2024 Form 1040. The IRS sends the refund electronically right into your account.
Simple enough. Can you split it between accounts? Like checking and savings?
Yes, that's a great feature. You can use Form 8888, allocation of refund, to direct deposit your refund into up to 3 different accounts. Could be checking, savings, even certain retirement accounts. It's a nice way to automatically allocate your refund.
Now, here's where it gets really interesting. Direct depositing into an IRA. You mentioned that earlier. It sounds like a smart way to boost retirement savings, but are there pitfalls?
It is a smart strategy, but you have to be careful. Yes, you can direct deposit all or part of your refund directly into a traditional IRA or a Roth IRA, but not a simple IRA.
Okay. What are the critical steps?
First, the IRA account must already be established at a financial institution before you file your return requesting the direct deposit. You can't set it up afterwards.
Account must exist first. Got it.
Second, you need to inform the IRA trustee or custodian about which year the contribution is for example, for your 2024 contribution. And here's the crucial caution. The direct deposit must actually be made by the tax filing deadline for that year, usually April 15th, not counting extensions, for it to count as an IRA contribution for that year.
So if the refund is delayed past April 15th, it doesn't count as a 2024 IRA contribution.
Correct. Even if you requested it on your return filed in February. If the deposit hits your IRA on April 20th, it's too late to be a 2024 contribution. You might then need to amend your return to remove any IRA deduction or saver's credit you claimed based on that expected contribution.
Wow, okay, so timing is critical. Plan ahead. Communicate with your IRA provider.
Absolutely. It's a great option, but requires careful execution.
Any other direct deposit mistakes to avoid?
Yes. Never have your refund deposited into your taxpayer's bank account. It's often a sign of a scam or shady practices. And triple check your routing and account numbers.
Wrong numbers mean?
The IRS isn't responsible if your refund goes to the wrong account because you provided incorrect information. Recovering it can be a major hassle or sometimes impossible. Always verify with your bank if you're unsure.
Good advice. How can people track their refund status?
Easily online. Go to irs.gov refunds or use the IRS To Go mobile app. You'll need your Social Security number, filing status, and the exact refund amount. Info is usually available within 24 hours after e-filing or about 4 weeks after mailing a paper return.
And they update it daily?
Usually just once a day, typically overnight, so checking multiple times a day won't speed it up.
Okay. What if you have an overpayment, but you don't want a refund check or direct deposit? Can you just apply it to next year's taxes?
Yes, that's an option on line 36. You can elect to apply all or part of your 2024 overpayment to your 2025 estimated tax liability.
Seems like a good way to get a head start for next year.
It can be, especially if you expect to owe estimated taxes anyway.
Yeah.
But be aware, this election is generally irrevocable. Once you choose to apply it to 2025, you can't change your mind later and ask for that money back as a refund for 2024.
Irrevocable. Okay, important detail. Now, for the less fun part. What if you owe money? Line 37. What's the deadline? And what are the best ways to pay?
The deadline to pay your taxes is generally the same as the filing deadline, April 15, 2025, for most people filing their 2024 return. Paying on time is crucial to avoid interest and late payment penalties. You don't need to pay if the amount owed is less than $1.
April 15th to pay. What methods does the IRS recommend?
They strongly prefer electronic payments for speed and security. The best options are IRS Direct Pay, free, secure bank transfers directly from your checking or savings account via the IRS website or IRS To Go app. You can schedule payments in advance,
Direct pay. Okay.
pay by card or digital wallet. You can use a debit card, credit card, or digital wallet like PayPal or Venmo through approved third-party payment processors listed on irs.gov. Be aware these processors usually charge a fee.
Fees for cards wallets.
Right. And electronic funds withdrawal, EFW. This is an integrated option when you e-file using tax software or a tax professional. You authorize the payment directly as part of the filing process.
EFW when e-filing. Convenient.
Very. Those are the main electronic ways.
What about non-electronics? Can people still pay by check? Or even cash?
You can pay by check or money order. Make it payable to U.S. Treasury for the exact amount due. Crucially, do not staple or attach the payment to your tax return itself.
Not attach it.
No. Instead, include Form 1040-V, payment voucher with your check or money order mailed separately, or with your paper return but not attached. Write essential info on the check. 2024 Form 1040, your SSN, the tax year, your name, address, phone number, and know that the IRS might convert your check into an electronic funds transfer anyway.
Okay, use Form 1040-V. What about cash?
Paying with cash is possible, but never send cash through the mail. That's incredibly risky. You have to use specific methods involving payment processors or retail partners who can accept cash payments for the IRS. Details are on irs.gov pay cash.
Okay, specific cash partners. Good to know. Now the really tough question. What if you owe money, but you just can't pay the full amount by April 15th? What should you do?
This causes a lot of anxiety, but ignoring it is the worst thing you can do. If you can't pay in full, the first step is still to file your return on time or file an extension. Filing late incurs penalties separate from paying late.
File on time even if you can't pay. Got it. Then what?
Then pay as much as you possibly can by the deadline to minimize penalties and interest. For the remaining balance, the IRS offers several options. The most common is an installment agreement.
Paying in monthly installments.
Yes, you can apply online for a payment plan if you meet certain criteria, generally owing under $50,000 in combined tax, penalties, and interest. It allows you to make monthly payments for up to 72 months.
Okay. Does interest still apply?
Yes. Interest and late payment penalties continue to accrue on the unpaid balance, even with an installment agreement. That's why paying as much as possible upfront is key. It's also wise to compare the IRS interest and penalty rates to other borrowing options, like a bank loan or credit card. Sometimes those might be cheaper, though not always.
So explore installment agreements, but no interest still adds up. Any other options besides monthly payments?
You could request an offer in compromise, OIC, where you ask the IRS to settle your tax debt for less than the full amount owed. But the standards for acceptance are very strict, usually only granted if there's serious doubt the IRS could ever collect the full amount. There's also requesting a temporary delay in collection due to hardship, known as currently not collectible status.
OIC and currently not collectible are harder to get.
Much harder. The installment agreement is the most accessible option for most people who need more time to pay. You can also request a short-term payment plan, up to 180 days, often with fewer formalities than a long-term installment agreement. The key is contacting the IRS and making arrangements proactively.
Proactive communication is key. Okay, Great overview of payments and dealing with balances due. Let's move into our final segment. Staying safe and getting help. Tax season is unfortunately prime time for scams, and understanding penalties can save a lot of grief.
Absolutely critical. Let's quickly cover penalties and interest first. Interest is charged on any tax not paid by the due date. It also applies to some penalties. It compounds daily, so balances can grow.
Daily compounding. Ouch. What about penalties for filing or paying late?
There's a failure to file penalty if you don't file your return by the due date, including extensions. It's usually 5% of the unpaid tax for each month, or part of a month the return is late, capped at 25%.
5% per month for filing late.
But if the failure to file is deemed fraudulent, that penalty jumps to 15% per month, capped at 75%. And if your return is more than 60 days late, there's a minimum penalty for 2024 returns filed late. It's $510 or 100% of the tax owed, whichever is smaller.
Minimum $510 if over 60 days late. That's steep. What about paying late?
There's a separate failure to pay penalty. This is usually 0.5%, half a percent, of the unpaid tax for each month, or part of a month. The tax remains unpaid, also capped at 25%. This penalty applies even if you filed on time or got an extension to file.
So penalties for filing late and for paying late.
Yes, they can apply concurrently, though the combined penalty is usually capped at 5% per month total in the months where both apply. The failure to file penalty is generally much higher than failure to pay, reinforcing the importance of filing on time even if you can't pay immediately.
Good point. Any other major penalties to be aware of?
There's a hefty $5,000 penalty for filing a frivolous return. This applies if you file something that doesn't include enough information to figure the correct tax, or shows a substantially incorrect tax because you're taking a frivolous position or trying to delay or interfere with tax laws.
So no arguing that income taxes are voluntary or anything like that.
Definitely not. That's a quick way to get a $5,000 penalty. There are also penalties for things like negligence, substantial understatement of tax, and in severe cases of willful evasion, potential criminal penalties. The bottom line: file accurately, file on time, pay what you owe, or make arrangements.
Okay. Let's talk security. Identity theft is a huge concern during tax season. How can listeners protect themselves from someone filing a fake return using their info?
So what does this all mean for you and your security? The single best tool the IRS offers now is the Identity Protection PIN, or IPPIN.
IPPIM. What is that exactly?
It's a unique 6-digit number known only to you and the IRS. If you have an IPPIN, it acts as a key to unlock your tax account for e-filing. Any electronically filed return submitted without the correct IPPIN will be rejected.
So it stops fraudsters who only have your SSN.
Exactly. It adds another layer of authentication. And the great news is all taxpayers can now voluntarily opt in to get an IPPIN.
Anyone can get one.
The easiest way is online through the Get an IPPN tool at irs.gov/get-in-a-pin. You have to verify your identity through their secure process. If you can't verify online, you might be able to apply by filing Form 15227 or by making an appointment at an IRS Taxpayer Assistance Center.
Okay, irs.gov/get-in-a-pin. Is it mandatory to use it if you have one?
Yes. If an IPPN has been issued to you or your spouse or dependent, you must enter it correctly on your tax return when prompted by your software or tax preparer for the return to be accepted electronically. It's required for a valid signature.
Mandatory if issued. Great protection tool. How else can people spot and avoid scams? Those fake IRS calls and emails seem relentless.
They are. This is vital. Remember the IRS's standard operating procedure. The IRS never initiates contact with taxpayers by email, text messages, or social media channels to request personal or financial information.
Never initiates via email, text, or social media for sensitive info.
Correct. They also won't call you demanding immediate payment using specific methods like prepaid debit cards, gift cards, or wire transfers. They won't threaten to immediately bring in local police or other law enforcement groups to have you arrested for not paying. These are all huge red flags.
Threats and weird payment methods equal scam.
Absolutely. If you get an unsolicited email claiming to be from the IRS, don't click any links or open attachments. Forward it to the IRS at phishing@irs.gov. If you get a suspicious phone call, just hang up. You can report misuse of the IRS name or logo to the Treasury Inspector General for Tax Administration, DOGTA, and other scams to the Federal Trade Commission, FTC.
Forward suspicious emails to phishing@irs.gov. Hang up on suspicious calls. Good rule.
The key insight is, be skeptical. If it feels wrong, it probably is. The IRS usually initiates contact about a tax issue via mail first.
Okay. What if someone genuinely needs help filing or has questions, We've covered a lot, but taxes can still be confusing. Are there free resources available?
Yes, absolutely. The IRS offers several great free resources. We mentioned IRS Free File, irs.gov Free File, for income-eligible folks to use free software.
And direct file coming soon.
And Direct File, irs.gov Direct File, for eligible taxpayers to file directly. Plus, free fillable forms for those comfortable doing it themselves. But beyond that, there's in-person help too.
Like VIA and TCE.
Exactly. The Volunteer Income Tax Assistance, VITA program, offers free basic tax prep to people who generally make $64,000 or less, persons with disabilities, and limited English speakers. Tax Counseling for the Elderly, TCE, offers free help particularly to taxpayers who are 60 and older, often specializing in pension and retirement issues.
VI and TCE, where do you find them?
You can find local VITCE sites using locators on the IRS website or by calling the IRS. They're often located at libraries, community centers, etc., especially during tax season. Also, for military members and veterans, there's MilTax, a free service through the Department of Defense.
Lots of free help options. Don't assume you have to pay a lot for tax prep if your situation is relatively straightforward.
Definitely explore the free options first.
What about online tools? For people who want to find answers themselves, the IRS website seems huge.
It is huge, but it has great tools. IRS.gov Tools has specific calculators and assistance, like the Earned Income Tax Credit Assistant we mentioned, or an online EIN application for businesses.
Okay. What about general questions?
IRS.gov Help is a good starting point. It has the Interactive Tax Assistant, ITA, which asks questions to guide you to answers on various tax topics. You can also find all forms, instructions, and publications at irs.gov Forms.
Forms and pubs, always useful. Can you see your own tax records online?
Yes, through your IRS online account at irs.gov OneGov account. You can view things like your tax payment history, balance owed, transcripts, information from key tax forms, and even manage communication preferences and view digital copies of certain IRS notices.
Online account is powerful.
Very. There's also a document upload tool now for responding digitally to certain notices, which is convenient. And for language access, Schedule LEP lets you request communications in alternative languages, though that's still rolling out. If you really need face-to-face help with an issue you can't resolve online or by phone, you can find local taxpayer assistance centers, TAPCs, using irs.gov Tech Locator, but they operate by appointment only now.
Appointment needed for in-person tax help. Good to know. Finally, it's important people know they have rights when dealing with the IRS, isn't it?
Absolutely. The Taxpayer Bill of Rights outlines 10 fundamental rights. These are embedded in the tax code and guide how the IRS interacts with taxpayers.
What are some key ones?
Well, the right to quality service clear communication, the right to pay no more than the correct amount of tax ensuring accuracy, the right to challenge the IRS's position and be heard providing evidence, raising objections, the right to appeal an IRS decision in an independent forum, taking your case further if needed.
Appeal rights. Important.
Very. Also, the right to confidentiality, protecting your information, and the right to retain representation, having a qualified professional assist you. Knowing these rights helps ensure you're treated fairly throughout the process.
Good to know those protections exist.
They do.
Well, there you have it. This deep dive, hopefully, has armed you with a much clearer roadmap for tackling your 2024 tax return. We've gone item by item from the latest updates in Who Files, through reporting income, and crucially, identifying those deductions and credits that can genuinely lower your tax bill.
You really do have the knowledge now to move beyond just, getting taxes done to truly managing your taxes. Using this information, combined with your own financial details, puts you in control.
Absolutely. So as you gather those W-2s, 1099s, and receipts, think about this. Every single dollar you save through a deduction you earn or a credit you qualify for. That's not just a number on a form. It's a direct investment back into your life, your goals, your future.
Well said.
So, what will you do with the insights from today to ensure your financial fitness this tax season? Remember, this is a general guide. Always apply it to your specific situation.
Thanks for joining us on this deep dive into the 2024 tax season.
We'll see you next time.